Okay, an important lesson Friar learnt this morning. Before we put money behind any number, find out what that number is assuming. What assumptions have they made? Almost every forecast we will ever read is a conditional statement framed as a prediction. And I'll go through how that nearly cost Friar and how spotting it changed what I did. On Monday, the 17th of August, a couple of days ago, refining a barrel of crude into diesel made an all-time record profit, $102.20 a barrel. And if we get some sense of scale on that, in a normal year that figures about $18. The previous record was $89 set in October 2022. That was during the last energy shock. So refiners are earning roughly 5.5 times their usual margin. And the only question that matters for anyone thinking about putting money behind it is, how long does that last? Now that's the question. Okay, a quick bit of vocabulary so that we're all on the same page. What's crack? And we're talking about in fuel, idea of crack. A refinery buys crude oil and cracks it. That's the industry word for making into useful fuels. Petrol, diesel, jet fuel, heating oil. The crack spread is simply what the fuel sells for, minus what the crude cost. Thus, the refiner's profit margin per barrel. So a wide crack spread doesn't mean oil is expensive necessarily. Rather, it means refining is the bottleneck. There's not enough working refineries and the diesel that comes from them. Okay, this didn't happen for one reason. 5 things landed on top of each other. First, the conflict with Iran left crude and refined fuel stuck behind the Strait of Hormuz. 2, Ukrainian drones have been hitting Russian refineries. Moscow responded by banning diesel exports to keep the fuel at home. That took a big exporter out of the market. Third, drone damage in Libya and Houthi attacks on Saudi facilities, thus more supply off the board. 4, meanwhile, America was exporting diesel at record pace, draining its own tanks to serve everybody else. Friar would restate that as to manipulate the market price. And 5th, the result, US diesel stocks going into late August in their thinnest since 1996. That's 30 years. None of these are about how much oil exists in the ground. Every one of them is about getting it refined and delivered. So obviously, why doesn't the US government just open the Strategic Petroleum Reserve? This would lower the cost of the refiner's raw material while the shortage is still in the refining capacity. Thus, refiners widen their margin, not reduce it. And look at the chart. The reserve has been drained from 727 million barrels at its 210 peak to 299. That is the lowest since January 1983. And it is now below the level at which engineers start worrying about the salt caverns the oil is stored in. There's not much left to release, even if it would help, which it wouldn't. It's a refining bottleneck. Okay, yes, the forecast that's often quoted. The US Energy Information Administration, the EIA, is the American government's energy statistics agency. Serious people, serious work, published monthly, free for the public to read. In August, they said the diesel margin falls from about $102 as it is today to around $41 by 2027. Brent crude from $87 down to $69, and wholesale diesel from $3.37 a gallon down to $2.62. This is often quoted, banks reference it, journalists lead with it. And Friar put it in the spreadsheet this morning, where it did a great amount of work. It was one of the main reasons the algo told me not to buy any refining shares. That was a mistake. Not theirs, but Friar's. And here starts Friar's sermon. Read the small print, because it's printed in the EIA's own forecast tables in this sentence. EIA does not forecast unplanned liquid fuel production outages. So in plain English, they are not predicting that the wars will end. They are assuming it. Their methodology handbook says the same thing another way. It explicitly does not address geopolitical events. Thus, a forecast is useless without understanding the assumptions used. And once I looked, the assumptions are printed right there. Shipping through Hormuz recovers from September. Bollocks. Shut-in oil production falls from 6.5 million barrels a day to 1.5 by early 27. Bollocks. And shut-in oil production means temporary halting of extraction at the oil well, field or pipeline. Trade routes back to pre-war normal by early 2027. Cobblers. That is a 75% recovery assumed in 2 quarters, with 2 wars still running. Now, I'm not accusing anyone of anything. This is honest work, honestly labelled. The EIA is not in the business of predicting wars, and it doesn't pretend to be. The failure this morning was Friar's, not reading a conditional projection as though it was a prediction. That is a mistake many punters make, and why Friar enjoys making these videos, because I'm always learning new things. I taught many times in university, be careful of your assumptions when we were doing research. And this morning, I didn't do it. Okay, if we want to know how much weight those assumptions carry, look at the last time they were tested. In January this year, the EIA published a forecast for what American diesel would cost in the 3rd quarter. That's right now. They said about $3.41 a gallon. It's actually around $5.34, approximately. So they were wrong by 57%. From just 2 quarters out, and the crude was forecast at $56 for the year against about $91.60 as I type. Thus, it tells us exactly how much confidence to place in the 2027 figure that everybody is currently repeating. It is not a prophecy. It is arithmetic downstream of an assumption about the Middle East, Ukraine, and Russia. Okay, let's do some balancing. So Friar wants to be careful. He's not saying forecasts are rubbish, ignore them. That's stupid, as Charlie Munger would say. What a forecast like this genuinely good for, it tells us what the world looks like if the disruption fades on schedule. It's disciplined, published, and consistent, so we can compare this month against last, and it gives everyone a shared baseline, which means we can see who is arguing with what. What it's not, a forecast of whether the wars end. It's not a probability. There is no most likely attached to it, and not something to build a position on without asking what it assumes. So the habit before we trade on any number, ask what has to be true for it to hold. Okay, same companies but scored different ways. So I'll show you what this is worth in practice. These four are refiners: Valero, Phillips 66, PBF, and Delec. These businesses earning that $100 margin. Friar's scoring system rates each out of 10 and only trades above 6. Column 1 is the system run on the official IEA forecast. Today's profits are a peak that fades. Everything scores below 6, thus no trades. Column 2 is the same system with Friar's assumptions. These wars grind on, margins stay fat for longer, everything scores above 6. And check the bottom line. Nothing about those four companies changed between the two columns, not one fact. Only the assumptions did. That's how much weight identifying realistic assumptions, remembering what makes an assumption realistic, is always debatable. Something else to point out, EIA is not on their own. Goldman Sachs predicted Brent at about $80 for the fourth quarter of this year and $75 for next year, though they did mention a tail case of above $100 if the Hormuz closure continues. Sensible. JP Morgan, crooks. $78 by the end of this year and about $64 average for next year. In fact, they're below the EIA. Something dodgy. And the WTI futures curve itself is in extreme backwardation. At one point, it had December 2026 as much as $40 below the front months, being May 2027. One more potential trap we can talk about. Valero's shares look cheap, about 8 times next year's expected earnings. For most businesses, that's a bargain. But for a company whose profits swing with a commodity cycle, the cheapest looking moment's usually at the top. Why? Because the price earnings ratio uses today's enormous earnings on the bottom. So the market can already see those earnings falling. So it refuses to pay up. The low number is the warning, not the discount. A warning stated in the 1934 book by Benjamin Graham and David Dodd, called Security Analysis. For a cyclical, the lowest PE occurs at peak earnings. It's an old rule and a good one. And here is a check that needs no forecast at all. Every one of those four tickers was trading above the average price target of the analysts who cover it, close to its 52-week high. Whatever one believes about these wars, buying at the high is a poor entry. Being right about the world and wrong about the price is still a loss. And finally, what did all this actually authorise? 18 ideas passed the scoring once I used Friar's own assumptions. 7 survived after I capped the correlated bets, because 4 refiners all betting on the same diesel margin is one bet, not 4. using a single idea in 4 tickers and calling it diversification is how punters lose their money. And under the official forecast, the same system allowed 3. 3 rules underneath all of it. Conviction sets the size. 1 contract is the base. 5 is Friar's ceiling. There is no size 10. Every position closes at half to 75% of what it could make. You do not need to last it out. You don't need to pick the top. Get the most. And nothing goes on across the earnings announcement. 7 positions out of an entire market at an all-time record. That's not hesitation, but that's what the arithmetic allowed. Okay, finally, part 2. 3 things to take home. First, a forecast is a conditional statement. Somebody assumed something to produce it. Find out what they assumed before we risk our money on it. Second, cheap at a record is rarely cheap. If something seems too good to be true, it probably is. When a commodity business trades at its lowest multiple, the market is telling us its earnings are about to fall. Third, and most difficult, most of the time we should do nothing. Friar's system found 7 positions worth taking across an entire market that is at an all-time high. That's normal for Friar's system. And again, Charlie Munger put it best. The big money is not in the buying and the selling, it's in the waiting. Good luck to all.